There is so much happening in the real estate world and the mortgage industry. I've got a lot to share with you, so let's dive in. Last week, the Fed met for the first time this year, and they raised their interest rate 25 basis points, or 0.25% of an interest rate, which was expected. Which was surprising to me is that mortgage interest rates came down again. So now we're right around 6%, maybe just a smidge above 6% on a 30-year mortgage, and hopefully we'll continue the downward ticking of those interest rates, which will really help out with affordability. Well, a few days after the Fed met, the jobs report comes out. Every first Friday of the month, the jobs report came out. And for some reason, they were only anticipating 187,000 new jobs. Well, guess what the result was? 517,000 new jobs. So I think that if Chairman Powell and the Fed had met prior to or after the jobs report came out, they may have raised it a little bit higher than 0.25%. Because remember, what the Fed is trying to do right now is slow down the economy. And when jobs are showing up as smoking hot as they are right now, it's the opposite result of what they're actually going for. So yes, the Fed is actually trying to slow down our economy, and as a result, they keep increasing these interest rates. They will likely raise it again the next time they meet. The Fed is scheduled to meet 8 times per year, so stay tuned to see what happens there. But Fannie and Freddie are putting into effect some really big changes. So this is going to affect 30-year mortgages for a whole lot of people. So let's look at what this looks like. Fannie and Freddie is who most banks and lenders use as the guarantor of that mortgage. So the majority of 30-year conforming interest rates, conforming loans that are originated are backed by either Fannie Mae or Freddie Mac. So they have come out with some really big changes. So let's focus on the price adjustments that they are changing. So there's price adjustments on mortgage loans for a variety of different reasons. So if you have a lower credit score versus a higher credit score, there's going to be an adjustment to that rate that makes your interest rate a little bit higher, right? If you put down a huge down payment versus a tiny little down payment, there should be a difference in that rate. So that's called a loan level price adjustment. If you're buying an investment property versus a primary home, that investment property is going to come with a higher interest rate. So there's a variety of different reasons why those rates are different depending on what the type of loan is that you're getting. So here's some really major changes that have come into effect. First, they added a couple new levels of thresholds for credit scores. It used to be 740 and greater, all kind of fell into this one level, and that was like perfect on paper. Now they've just added 760 and 780. This goes into effect in a couple of months. It's not quite here yet, but you will see a difference now. Instead of just being 740 and higher, the adjustments are going to be more tethered and so layered, and it will go 760 and 780 plus. So if you're perfect on paper, it's now 780 and no longer 740. Another big adjustment, and this one is really going to be scary for a lot of people. It starts in May of 2023. So basically loans that will close in March and April will be fine, but then after that, it's going to go into effect. If a borrower has greater than a 40% debt to income ratio, there's a hit or an adjustment upward on that interest rate for that borrower. So that means those who are carrying any significant amount of debt, student loans, car loans, personal loans, credit card balances, all of that is smushed together along with your new housing payment for part of the qualification on a mortgage. And if it's over 40% of your gross income, so if you're W-2, take your annual, look at your monthly income. We base everything off of your monthly income. So divide your annual by 12, look at that monthly income. And if you multiply that by 40%, if your debt, including your housing, goes over that amount, you're going to have to pay a higher interest rate. So those people who are already straddled down with debt obligations are now going to pay higher on that interest rate because of that debt. So not such good news. Also, going into effect in March, a little bit earlier than what I just spoke about on this last one, if somebody is seeking a cash out refinance on an investment property, They used to have to wait 6 months of ownership before they could do that cash out investment refinance. Now we have to wait 12 months of ownership before we can do that cash out investment ownership. There is a loophole to this. It's called delayed financing. So if you just use the cash out of your own pocket and you paid it and you want to kind of reimburse yourself, there's no weight limit on that. But there are pricing adjustments for a cash out refinance, and then an additional layer of a pricing adjustment because it's an investment property. So it is a higher interest rate than if it were your primary home. Some people will do a tandem loan, in other words, a conforming first mortgage, and then they will put with that a piggyback like home equity line of credit or second mortgage. A lot of times they'll do that because you want to avoid mortgage insurance, but you don't have a large down payment, you don't have 20% down. Sometimes it's because the conforming loan limit, which is now at just above $726,000, if you're purchasing a home and borrowing greater than that $726,000 and some change, then it's a jumbo loan. So to avoid a jumbo loan and stay in that conforming loan limit, you can get a conforming first mortgage and then do a piggyback with a second mortgage to get you to your desired amount. Now, if you're going to do that, it will cost you a little bit more on that first mortgage because now there's a loan level price adjustment, which really didn't exist before. It was very nominal. It didn't really show up, but now it does. So lots of huge changes. The last one that I want to share with you is on a positive note, since I gave you a couple of things that are kind of yucky as far as what it's going to cost us. So I'll leave this one on a positive note. Those with a 680 credit score or lower were really getting beat up on the interest rates on their loans. Now that is not so severe. So where it may have cost us, say 2.5% more than if you had a really high credit score, now it might only cost, say, 1.25%. So in other words, the interest rate hit it's not as severe as it was. Now, this isn't going to go into effect for a couple of more months. We probably won't see that getting started, baked in until like late March, early April, because it goes into effect in May of 2023. But when it does, it's going to be a very positive thing for those who have a lower than a 680 credit score and they're financing a large amount, say 90, 95, even 97% financing, because that's what you can do. You can get away with 3% down if you're buying your first home on a conventional mortgage. If you have questions regarding this, reach out to me. I'm happy to be a resource for you. You can email me at questions@creditchristie.com. I hope this brings you a ton of value. Just know there's a lot going on in the mortgage world. It is definitely affecting our real estate world. So you're probably seeing where prices are coming down nice and easy in most markets. Goldman Sachs just came out with an interesting article that is stating that 5 markets, mostly on the west coast of the United States, is anticipated to have as much as a 25% hit to their values. Now, they soared in values even greater than 25%. So if they do come down this year, it will probably just get close to leveling out to where we were, say in 2019 or even the start of 2020. So maybe it will be a more balanced market for people who are paying way too much on some homes in some of those markets and are really feeling the strife of affordability, because let's face it, our housing payment tends to be our largest single cash outflow. In other words, that's the most expensive part of our budget for our costs each month. And if that is through the roof, it's going to affect our spending on everything else. And I'd already shared with you that because of the Fed funds rate increasing, the APRs on credit cards, the interest rate on auto loans, those have all gone up as well. So it's creating kind of this perfect storm of some extra costs in our lives. So if it does come down a bit, I think those people in the market would probably be really appreciative if they're looking to be buying a home. But I'd love to hear what you're experiencing, what you're seeing, your perspective, because real estate is so localized. I'd love to hear what's going on in your market. So thanks for watching.